Okay, guys, welcome back. And today we have to discuss. First, let me tell you that today the lecture number. Yeah, definitely this is lecture number 5. And this lecture will discuss accounting manipulation and key concept and impact. Okay, first you have to understand that what we mean by the accounting manipulation. When a company change numbers or rules to make their financial reports look better, then we call that as the accounting manipulation. So when the company change numbers and rules for their own benefit, they want to make their financial reports look better. Then we call that is the accounting manipulation, right? Now it's often done to trick investor because the report is just for the user and the user is investors. They want to track their investor. They also want to hide problems, and or you may say like to meet the targets. For example, if a company record a fake sale to boost profit, so making it look successful when it is done, so we call that as accounting manipulation. Now if you see here, accounting accounting may adjust accounting treatment to present a desirable financial picture, and this may not reflect the true economic substance of the transaction. An accounting policy can significantly impact financial ratio. Now let's talk about the key financial metrics that affected, that is the earning per share, EPS. By EPS, we mean that the EPS actually a metric that measure the profit per share. S is measuring the profit per share. Okay, of the stock. So how much money each shareholder gets, then that will show you the APS. Now manipulation, when you look for the manipulation, then the companies might hide expenses. When they hide expenses, then definitely increase their profit, and at the end the APS also goes up, right? So for example, a firm skips recording 1 million in cost. So the EPS jumps from the $2 to $3 per share. So that is the type of manipulation, and that will affect the EPS, right? Now, on the other hand, we have another key financial matrix, that is the uh, return on the capital employment, capital employed, that is ROC, which shows that how will a company use its capital uh, capital to make profit, right? So return on capital employed means that this financial matrix shows that how will a company use its capital to make profit. The manipulation here is overstating the asset or profit. So overstating asset or profit uh, can inflate the return on capital employed ratio. So, for example, a company overvalues its factory, so that will boosting return on capital employed ratio from, let's say, from 10% to 15%. Okay. Now the third one is, we are just talking about why we're discussing these ratios. The purpose is, when you are doing when you are manipulating the numbers and rules, then definitely this will have impact on your EPS, on your return on capital employed. Now the third ratio is gearing, that's debt to equity ratio, which measure how much a company relies on debt compared to the equity. So, hiring debts, lower gearing. When you are hiring the debts, then the gearing it will show low gearing, making the company seem less risky. If the companies are more relying over the debt, it means that this is a risky company because they are relying over debt compared to the equity, right? For example, a firm hired 5 million loans. So dropping the gearing ratio from one percentage to another percentage means it will lower the gearing ratio. And when the gearing ratio is lower, then the investor will be tricked that this company is not risky. When you present the equal ratio, the equal position of the debt, then it will seem like that your company is risky, and the investor will not invest in your company, right? Now let's move on. Here we have a situation where accounting policy matter. We have discussed it. What are the situation where accounting policy matters? So accounting policy are the rules a company picks to report its number. So means that these policies are the rules which the company picks to report its numbers, and they matter when companies want to look profitable to attract investor. They need to lower risk to get loan. They are trying to meet targets set by the boss or the regulator. So these are the policies which is required, and why it's matter. The reason I have told you that because of this policy, you can manipulate the numbers, and when the number is in your direction and your favor, then this is the good for the investor, and this will attract your investor. And if you see, if the company look profitable, then definitely they will attract investor. And if you are not relying on it, then the company will be showing that the company is at lower risk, and definitely they'll also attract investor. And sometimes you want to meet the target. For that reason, you can also using the accounting policies in your favor. Now, accounting policy are especially important when standard allow choices in accounting treatment. Judgment is required for estimates. No specific accounting standard exists. So these are the reasons I have told you. Let's say a company chooses a policy to value inventory higher, so making profit look a bit bigger, right? Okay. Now we have to discuss the accounting policy and choices. That how these are just the thing that you have to remember. In example of you can select example of accounting policy choices. So policy choice is deciding what we mean by policy choice is deciding how to value the asset. You go for the cost or fair value, and the impact will be that affect profit, balance sheet, and investor trust. So for example, a business picks fair value for its building, so it increasing its worth from, let's say, from $10 million to $10 million. So these are the policy, these are the choices you make to because this has impact on the profit, balance sheet, and investor trust. Now, specific standard and choices is, if you see here, this is the IS2 inventory standard, where the choices is you should use by using the wait, PIPO, that is called PIPO first in, first out, or weighted average, or weighted average. So these are the policy to value the inventory. Now, the impact will be this affect the cost of the goods sold and profit. So, for example, a store use that first in, first out during rising price, so showing lower cost and high profit, right? Now, the second one is the IS 16 profit line equipment, where we have the choices the value asset at cost or the value amount, that is the fair value. So the impact will be the change in asset value and also depreciation. So, for example, a factory is a revalue from let's say from $1 million to $1.5 million. That will boosting the balance sheet, right? The third one example, if you here you see, that is the IS 38 and intangible asset, where the choices you have used the cost model or revaluation model. We'll discuss all these in detail when we are doing the standard. There I have uploaded some standard. I think this one we have already recorded, the IS 38 intangible asset. So this will have impact the asset value and profit. For example, a brand is revalue from one value to another. So this will increase the net asset. Now we have the IS 40, that is the investment property. Here we have the choices that report at cost with depreciation or fair value with no depreciation. And we have also recorded this lecture. If you want to watch, you go and watch it. Okay. So there we have two options, two choices. That is, you have to report at cost with depreciation, and if you are using fair value, then there will be no depreciation. The impact will be changes profit and asset value. For example, a rental building at fair value gain a value of, let's say, $100,000 in profit, skipping the depreciation. If you want to skip the depreciation and you value the fair value, then that will be your choice. Now let's move on. We have the IFRS 3, the business combination, and the choices in this standard we have that to measure the non-current asset at fair value or proportionate share, and in fact will that goodwill that will affect the goodwill and equity. For example, if you are buying a company and valuing the minority interest at $50,000 mean fair value versus $40,000 share, that will changes and goodwill. The fifth one is IFRS 5, non-current asset held for sale, and this standard there's a choice that classifying the asset as held for sale or stop depreciation. So we have the choice that if you want to classify an asset as held for sale and stop depreciation. Now this will impact the profit will boost by avoiding depreciation. Depreciation is usually that as expense, so that will reduce your profit. And if you stop depreciation, then definitely your profit will boost. So for example, a machine worth $100,000, okay, and you are stop depreciating it, so that will let's say save $100,000 an expense, and that will boost your profit. And the last one is IFRS 9 financial instrument, where we have choices that classify investment as a fair value to profit or loss or amortized cost. So this will affect the profit and volatility. And the example will be, let's say you have a bond at fair value showing the $20,000 gain and profit. So while amortizing cost keeps steady, that will be your choice. So these things we will discuss one by one. IS 2 to IFRS 9. These are the separate standard, but we have just to conclude that why the companies are manipulating the number, and I have discussed the reason behind that there is some personal motive or there are some company motive. So manipulation of accounting, now if you see here, concept is the manipulation of accounting policies can alter the financial statement without changing the real business performance. Mean this will change your accounting, this will change your financial statement without your real and issue position. Effect on the ratios. We have discussed that changes in APA's return on capital employed gain can mislead the investor. So if you have a debt and you are not showing that debt, definitely you're getting well. What will the impact on the gearing? What will the impact on the return on equity? And these things will mislead the investor. Now, judgment and flexibility, the accounting rules allow choices they have, but there's no room for manipulation. Now, you see here, there is a choice. You can choose the cost model, or you can choose the fair value or revalue model. It's okay because it's allowed by the accounting rule specific to the specific standard, but there is no room for manipulation. If you go for the manipulation, then there will be the violation and you will have to face the consequences. Now, keep area to concern depreciation, amortization, asset valuation, inventory costing, and financial instrument classification. So we have discussed this in a very detail. Let me wrap up. These choices in accounting policy can twist the truth, impacting the EPS, return on capital implied, and gearing. So ethically, SPR demand fairness and transparency, not manipulation or selfish gain. So as for the concern of the ethics, uh, these things should be fair, should be fairness and transparency, and there should not be any manipulation, because if you are manipulating the numbers, then this will mislead the investor and this will have a bigger impact on the user. So we have discussed the accounting policies and how they have impact on the user. Okay, thank you for watching.